Welcome to HC Economy. We have some relief from the relentless dollar climb and the very sharp rupee fall that we saw yesterday. But where do we go from here? Has the dollar got more strength, or will it peak in the first few days of the Trump presidency? And what about the US yields? The rupee, India's own Reserve Bank's ability to cut. For all these, I'm joined by Kamakshya Trivedi, the head of Global FX and EM Strategy at Goldman Sachs. He is joining us from the sidelines of the Goldman Sachs Global Macro Conference in Hong Kong. Kamakshya, thank you very much for finding time for us in between your conference. Well, news hit us this morning that the Trump administration may not rush with tariffs. They will space it out, and the dollar index has gone down from about 110 to 109.6. Do you think the dollar has peaked in the near term?
No, I don't think so. I think our view is very clear on this. We think the dollar is going to be stronger for longer. We have just marked our forecasts in that direction. We think there's another 4 or 5% upside still to the broad dollar trade weighted index. So, this is a combination of continued firm U.S. growth, U.S. exceptionalism, and shifts that are occurring on the rate side, but also tariffs. Tariffs are coming, and I think that's a key part of our view of dollar upside from here.
You said 4 to 5% appreciation from here. So can we say you see 115 as the peak for the dollar index?
I think that there are still risks to the upside even from that level. I think that, our baseline expectation is of tariffs that are reasonably targeted towards China, towards certain specific industries. And certainly, the report you mentioned that has been in the news, suggests that some of these might even start more gradually than we are factoring in. But I think one shouldn't lose sight of the other tail. It is still possible that tariffs are much more broad-based, more universal. Certainly members of the president-elect's camp have talked about that. If we get something of that nature, that has a bigger impact on underlying inflation in the U.S. that puts the Fed on hold for an extended period. I think that's the kind of scenario that gets you to, further dollar upside than even we are targeting. So I think we are going to be living in a strong dollar world for some time to come, and I think, one should be prepared for that.
Oh, that looks serious. Okay, what about the rupee? It fell, 3% versus the dollar in 2024. But the last 2 days, in fact, last week, the rupee's had a rough patch. Do you think we should prepare for just another 3% depreciation this year?
I think that what you're seeing with the rupee is that, this used to be, roughly a 6-7 wall currency. Through parts of last year, it became almost peg-like in its behavior, a kind of very, very stable rupee. And I think while it's helpful for the rupee to have this resilience, I think that kind of very peg-like behavior is not too healthy either. And what you're seeing now is a little bit of a release of the very tight management of the rupee that you've seen. I think that's part of why you're seeing the weakness. And I also think, India itself is having a little bit of a cyclical slowdown. If you think about the rupee in comparison to the dollar, where, as I just mentioned, you're seeing kind of pretty exceptional growth, it makes sense that you see a bit more weakness in the rupee. But I do think that, ultimately, as we look across the year, relative to other Asian currencies, the rupee will still be an outperformer. But I think there's more weakness to come versus the dollar. I think the common theme here on an FX standpoint is don't fight the dollar. I think you want to be thinking about the rupee in reference to other EM currencies, in reference to other Asian currencies. And there, I think we're still going to see a relatively managed, a relatively outperforming rupee. But versus the dollar, I think there's more weakness to come.
Okay, that's a good way to learn to think about the rupee versus other currencies and not only against the dollar. Let's get to interest rates. Some say there are no rate cuts to be expected from the Fed at all this year. Of course, that's not a big camp, but your thoughts. Also, the 10-year yields in the US, they've hit 4.8. Now, where do we go from here?
Look, our view is that there are still probably another couple of cuts from the Federal Reserve this year. What that reflects is the fact that alongside firm growth, we also have confidence in the other aspect of the soft landing view, which is that inflation should continue to gradually normalize. Some of that is happening. Some of that might be interrupted by the tariff news, and therefore I think the extent of the tariffs, the pace at which they come on are critical. But by and large, we think that broader inflation normalization process is going further, and the funds rate is starting from a relatively high level. So there is still some room, we think, for another couple of cuts. Of course, there is no rush to deliver them, which is why we think, the next cut could be, as late as June, and second one in the second half of the year. So certainly fewer cuts with less urgency than we saw back in 2024, but I think still further cuts to come. What does that mean for yields, as you ask, longer-term yields? Look, we've been through a phase, I'd say particularly over the past 6 weeks after the Trump election, where essentially, we've seen a prolonged upgrade of U.S. growth views. That's been evident in equity markets, cyclical versus defensive. It's been evident in the dollar, as we just discussed, but it's also been evident in yields. Yields have gone up together as well. I think that it's going to be hard as we start to actually get the policy mix from the Trump administration. We're going to have to face the trade-offs of these. And I think it's going to be hard for all these three assets to keep going up together. And in particular, I think the yields are probably vulnerable to any sign of a growth disappointment or better inflation news. So I'd say, compared to kind of long equity view, which we still hold, a long dollar view that we still hold, I think on the yield side, I think, the risks are becoming a bit more asymmetric. Our target for the end of the year is between 4.3 to 4.5%. So we actually see some downside to the yield level from the current levels, in line with the fact that we see a couple more rate cuts still to be priced in.
Okay, all that will be good news, I guess, for the Reserve Bank. But coming to domestic impulses, India's December CPI has come in below consensus at 5.2%. And while actually 5.2 is high, it has been falling sharply for the past 3 months and is seen falling more sharply in the Jan-Feb-March quarter. Now, does all this give Reserve Bank a space to cut rates in February itself?
We are penciling in a couple of cuts from the Reserve Bank in the first half of the year. Probably February and April seem like the likely outcome. As you mentioned, I think inflation has been trending lower in the last couple of months. We've seen some relief on both the headline, but also some of the core pressures. And our expectation is that some of that should continue. A shallow but cutting cycle, couple of cuts for the year is our expectation. We've also seen some tightening in underlying liquidity with some of the FX moves that we talked about at the earliest. So I think couple of cuts, and I think February still is our base case for the next cut.
Oh, February. Okay. The camp is equally divided. By the way, I forgot to ask you your rupee target as well for this year.
We have a 12-month target of 87.5 right now, I think, so along those sorts of lines. As I said, I think, we will see the rupee depreciate versus the dollar. That's where we are penciling in right now. 87, 88, that sort of level seems sort of about right to me, but that should still, on our forecasts, see the rupee outperforming versus other EM Asian currencies.
Okay, got that. Well, let me come back to this conference of yours where you all are discussing global macros, especially in a post-Trump administration scenario. What is your own base case on the Trump tariffs? So will it be 60% or more modest at, say, 20%? Will it be for all goods or some goods? Will it be all countries or only China? What's the base case?
Our base case is that tariffs are going to come early. We think that they are going to be, 60% on some, parts of China's sort of products, with a baseline for us that the effective average tariff rate goes up by about 20 percentage points. And then perhaps some targeted tariffs on particular industries. I think things like the auto sector, for example, is one that is, often mentioned and in focus. I think beyond that, the big uncertainties around the universal tariffs. Could you get across the board tariffs on a wider range of countries and a wider range of products? No one I speak to does not expect some tariffs on China. I think that's very much the baseline expectation that I encounter when I speak to investors. Where there is a lot more uncertainty is, can you see these sort of broader across the board tariffs? Those, would be a good example of what I was describing earlier. The broader the tariffs, the bigger the impact on the dollar, but also potentially a more negative impact on the equity market. And so this sort of trifecta that we've had of the dollar, equities, and rates going up all together, I think we're going to have to pull those apart a little bit as we actually learn about what the policy mix is.
Oh, yes, that's the wild card, isn't it? And I don't think, as you say, we will be any the wiser on Jan 20th itself. Thank you very much, Kamakshya. I'll take a rain check from you to invite you after we know a little more about the Trump tariffs. Thank you for joining us today. We have to wrap up on Bazaar on that note. After a break, Chartbusters.